Ever wondered why accounting is called the language of business? Well, just as language is fundamental to human interaction, accounting is integral to any business. It enables businesses to understand their financial position, make informed decisions, and communicate these decisions effectively. At the heart of it all are accounting principles and conventions. These are essentially the grammar rules of this business language, providing a framework for consistent, accurate, and reliable financial reporting. They are a set of guidelines that businesses adhere to when recording and presenting their financial information. From the entity concept, which distinguishes the business from its owners, to the principle of prudence, which ensures caution in reporting income and expenses, these concepts and conventions form the building blocks of accounting. So, are you ready to delve into this fascinating world? To decode this language and comprehend the stories it tells? Dive in deeper to understand the basic accounting concepts and conventions that form the backbone of accounting. What does an entity mean in accounting and why is it crucial? Let's dive into it. In accounting, an entity is a distinct economic unit, like a company or a corporation. This entity concept ensures that the business's financial transactions are separate from those of its owners or other businesses. It's like drawing a clear line in the sand. On one side, you have the business transactions. On the other side, personal transactions. This distinction is crucial for accurate and transparent accounting. Now, let's introduce the money measurement concept. Picture this. You're trying to compare apples to oranges. Tricky, right? That's where money measurement comes in. It states that business transactions should be recorded in terms of money. This provides a common denomination, a uniform measure, making it easier to compare and contrast different transactions. With these concepts, accounting ensures a clear distinction between personal and business transactions and a uniform measure for recording them. Ever heard of the terms going concern and cost in accounting? Well, let's dive into what they mean. The going concern principle is a fundamental assumption in the field of accounting. It suggests that a company will continue its operations indefinitely and will not liquidate or cease operations in the foreseeable future. This assumption allows businesses to defer some of its prepaid expenses until future accounting periods. But what about cost? In accounting, the cost concept is one that states an asset should be recorded in the books of accounts at the price at which it was acquired, that is, at its cost price. Not the current market price, not the future expected price, but the cost at which it was originally purchased. This provides a basis for consistent accounting methods and practices. These concepts ensure that financial statements reflect an accurate and ongoing picture of a business's financial position. Do you know when revenue is recognized in accounting? Well, this is where the realization concept comes into play. It's one of the fundamental principles in accounting that states that revenue is recognized when it is actually earned, not when it is received. This means that the moment you deliver a product or render a service, you can record the income, even if you haven't received the cash yet. Next up, we have the accruals concept. This is another key principle that records income and expenses when they occur, not when cash is exchanged. So, for instance, if you incur an expense in January but pay it in February, you would record that expense in January itself. Similarly, if you earn revenue in March but receive payment in April, you would record it in March. These conventions are not mere accounting formalities. They are the backbone of financial reporting, ensuring that financial statements accurately portray a company's financial performance. How does accounting ensure comparability and caution in reporting financial information? This is where the concepts of periodicity, consistency, and prudence come into play. Let's start with periodicity. It's a concept that breaks down a company's life into time periods for reporting purposes. Imagine a company as a long-running television series. Just as each episode of a series provides a snapshot of the ongoing narrative, periodicity allows us to dissect a company's lifespan into episodes or periods, typically a year. This enables us to track the company's performance over time, observing trends and making comparisons. Now, imagine if each episode of your favorite television series was directed differently, with inconsistent character portrayals and plot lines. It would be quite a challenge to follow, right? This is where consistency comes in. Consistency ensures that the same accounting methods are used across time periods. This makes comparisons meaningful and prevents manipulation of figures. It's like ensuring that each episode of the series maintains the same characters and plot lines, providing a coherent and comparable narrative. Finally, we come to prudence, also known as conservatism in accounting. This concept advocates for caution in recording income and expenses. It's a safety net, ensuring that profits are not overstated and losses are not understated. It's like the safety protocols on a film set, ensuring that no one gets hurt while filming those high-octane action sequences. Prudence is about being realistic, not optimistic or pessimistic, but keeping things grounded in reality. Accounting, like storytelling, is about providing a clear, consistent, and truthful narrative. Periodicity allows us to break the story down into digestible chunks. Consistency ensures that each chunk is comparable to the others, and prudence keeps us grounded in reality, ensuring we don't get carried away in our storytelling. These conventions ensure comparability, consistency, and caution in accounting. It's about presenting a story that's not just engaging, but also true, fair, and comparable over time. What dictates the level of detail in financial reports and how our expenses match to income? Let's dive into these intriguing questions as we explore the concepts of materiality, matching, and full disclosures in accounting. First off, we have the concept of materiality. This is the principle that suggests all significant information should be fully disclosed in financial statements. The idea here is that if an item's omission or misstatement could influence the economic decisions of users, it should be included. It's like going shopping. You wouldn't want to buy a dress without knowing its price, right? Similarly, in financial reporting, every significant detail counts. Next up is the matching concept. Imagine you're baking a cake. You wouldn't attribute the cost of eggs you bought last week to a cake you're baking today. Instead, you'd match the cost of the eggs to the cake you baked when you bought them. This is essentially what the matching concept is about. It requires that expenses be matched to the revenues of the same period. This helps in accurately determining the profit or loss for a given period. Finally, let's talk about full disclosures. This principle necessitates that all information that may affect a user's understanding of the financial statements be disclosed. It's like when you're buying a house. You'd want to know if there was a leaky roof or a faulty heating system, wouldn't you? Full disclosure in accounting is similar. It ensures that everything a potential investor, creditor, or stakeholder needs to know is out in the open. So, when we talk about materiality, matching, and full disclosures, we're really talking about the rules of the game in financial reporting. These conventions guide how financial information is presented, ensuring that it's complete, accurate, and transparent. They're like the traffic signals of the financial world, helping to guide and regulate how information flows. These conventions ensure completeness, accuracy, and transparency in financial reporting. So, what's the big picture of accounting? Well, let's tie it all together now. We've taken a deep dive into the world of accounting, exploring its fundamental concepts and conventions. We began with the entity and money measurement, understanding how accounting separates an organization from its owners and how it quantifies business transactions in monetary terms. Next, we discussed going concern and cost, two principles that underpin the longevity and valuation aspects of a business. We learned that accounting assumes a business will continue indefinitely and that assets are recorded at their original cost. We then moved on to realization and accruals. These conventions ensure that income and expenses are recorded when they are earned or incurred, not necessarily when money changes hands. This provides a more accurate picture of a company's financial health at any given time. Our journey continued with periodicity, consistency, and prudence. We discovered that accounting breaks down time into periods for reporting purposes, keeps methods consistent for comparisons, and exercises caution in financial reporting to avoid overstating assets or understating liabilities. Finally, we delved into materiality, matching, and full disclosures. These principles dictate that significant items affecting financial decisions should be fully reported, that expenses should be matched with revenues, and that all necessary information should be disclosed in financial statements. These concepts and conventions are not just theoretical constructs. They are the foundation upon which accounting practices are built. They guide how transactions are recorded, how financial statements are prepared, and how financial information is reported. In essence, these principles and conventions make accounting the language of business. They ensure that this language is consistent, reliable, and comprehensive, allowing various stakeholders from business owners to investors, from regulators to auditors, to understand, compare, and trust the financial information presented to them. All of these building blocks come together to form the big picture of accounting, a picture that tells the financial story of a business. With these principles and conventions, accounting becomes a reliable, consistent, and comprehensive language of business.